So let's look at what categories of debt funds exist. Earlier, there used to be massive set of categories that were there, and people used to have overlapping categories. Then SEBI came in one day and said that, okay, I'm going to define exactly what you call these, right? So there is an overnight fund which invests in overnight securities having a maturity of 1 day. We have bonds which have a maturity of 1 day. Overnight funds invest only in those, completely risk free, more or less, right? Unless something goes really wrong in the day and tomorrow someone defaults. Usually overnight funds are practically risk-free funds, right? Then funds with a maturity of 90 days up to 91 days is called a liquid fund, right? Then you get into the denotion of these. You will see that the way they have been denoted, these are the technical definitions taken from SEBI's document. So SEBI's website has this. Ultra short duration funds, now they start talking about Macaulay duration. Remember, Macaulay duration is being denoted in terms of days or months or years. So if the Macaulay duration is between 3 to 6 months approximately, that's your ultra short duration fund. Then low duration is 6 months to 12 months. Money market funds can have anything in this period, so maturity up to 1 year. Short duration funds, 1 year to 3 year. Medium duration fund, 3 to 4 years. Medium to long, 4 to 7 years. Long duration, greater than 7 years. Dynamic bond fund, investment across duration. Corporate bond fund, minimum investment of 80% in corporate bonds, right? But only in the highest rated instruments, right? So that's a corporate bond fund. Credit risk fund, right? Note the term credit risk. What was credit risk? That a company's bond gets downgraded or upgraded. We discussed a concept that AAA becomes AA becomes A. So rates expected will go up. If rates expected go up, the bond price will fall, right? But you could also have another thing, which is AA becomes AAA, in which case rates expected will go down and bond prices will go up. Credit risk funds invest 65% minimum of the total assets, which are below the grade of the highest rated instrument. So these are not in AAA. Note the keyword below, right? It is meant to be a risky fund. So this is a risky fund. People who understand debt markets will invest in this. People who don't understand debt markets should not be going there, because people who don't understand debt markets are typically looking at debt from the perspective of an understanding of what's capital preservation is, right? Then you have banking and PSU funds. Now, typically banks and public sector enterprises are either, because banks are heavily regulated and public sector enterprises are backed by the government, so quasi-government entities, these are again safer funds and they have to be 80% of the total assets. Gilt fund is 80% of the total assets across maturity, government securities only. So again, safe. Gilt fund with 10-year constant duration, right? That's like 80% of the assets will have a maturity which is fixed of, a Macaulay duration which is fixed to 10 years. So long duration funds, right? One of the concepts we need to understand with respect to duration is that your duration is directly proportional to your maturity. Longer the maturity, bigger the duration. So when I take a 1-year bond, my duration is going to be similar to, slightly lesser than 1 year or equal to 1 year, right? If I take a 10-year bond, my duration is going to be 8 to 9 years. And consequently, you will just note logically that if my duration is 8 to 9 years for a 10-year bond, the interest rate risk is the highest there, right? So now let's classify what kind of risks are playing here. So I'll erase this. This is risky. I will write this again. Here, you are looking for safety, right? This is capital preservation largely. This is some play on interest rate. This is a play on credit risk. To an extent, corporate bond funds are also a little bit of a play on credit risk. Not too much, but a little bit of a play on credit risk. These have interest rate risk, Large interest rate risk. Why? Because as you go down, you're seeing that the Macaulay duration is increasing. Macaulay duration is nothing but modified duration, or Macaulay duration by 1 plus R, R being the YTM is modified duration. So as Macaulay duration goes up, modified duration goes up. As modified duration goes up, your interest rate sensitivity goes up. We just need to remember this, right? So longer the maturity, higher the duration, higher the duration, higher the interest rate risk. It's also very intuitive. If interest rates are going up and you go to a bank to deposit money, would you take a 5-year FD or would you take a 5-day FD if rates are going up? You typically take a 5-day FD, right? Because you think that after 5 days, you'll get a higher rate. Why will you lock in money for 5 years? If interest rates are going down, you will go and take as long a maturity as possible. So if you feel that interest rates are going to go down, you go here. If you feel rates are going to go up, you go here in this category. Understood? Forget floater fund. Floater is different. If rates are going up, then you typically go for floaters, but that's only if you have to invest in debt at that point of time, right? Otherwise, typically a very simple yardstick is if you think rates are not going to fall further, you will be at the lower end of the spectrum in terms of maturity.